JBA24238. Today we are going to present about expectation theory and liquidity premium theory. First things first, we are going to introduce ourselves. My name is Nur Sakina binti Osman.
My name is Nur Amira binti Muhammad Hassan.
My name is Raja Muhammad Faris bin Raja Azhari.
My name is Siti Aisyah binti Muhammad Nur Syam.
My name is Muhammad Syari Amri bin Afandi. Let's proceed to the presentation.
Expectation theory aims to forecast what short-term interest rates will be based on existing long-term interest rates in the future. The theory implies that the investor gains the same interest by participating in two successive one-year bond investments compared to investing in one two-year bond. Today, investors should be cautious that the theory of standards is not always a reliable method. The significant thing with using the expectation theory is that it often exaggerates potential short-term yields, making it possible for investors to end up with an inconsistent forecast of the bond yield curve. The liquidity premium is the additional value sought by the investors when the security cannot be efficiently and conveniently sold or otherwise transformed into cash for its fair market value. When the liquidity premium is intense, the asset is said to be volatile, and investors in illiquid assets need protection for the added risk of investing their money in assets which might not be sold for a longer period of time, particularly because valuation might fluctuate with market effects in the meantime. In general, investors who want to invest in such risky investments need to be compensated for the added risks of a liquidity problem. Investors who have the funds to invest in longer-term investments can gain from the liquidity premium earned from these investments.
Now, I'm going to explain about the difference between the expectation theory and liquidity premium theory. So, firstly, for expectation theory, it states that the interest rate on a long-term bond will equal with an average of the short-term interest rate which people is expect to occur over the life of the long-term bond. The key assumption behind this story is that the buyer of bond do not prefer bond of one maturity over another. So they will not hold any quantity of a bond if its expected return is less than of another bond with a different maturity. That is, bondholders consider bond with different maturity to be perfect substitute. Compared to the liquidity premium theory, it states that the interest rate on a long-term bond will equal with an average of the short-term interest rate which is expected to occur over the life of the long-term bond plus a liquidity premium, which is also called as a term premium, which responds to supply and demand condition for that bond. In this theory, the key assumption is bond of different maturity are substitute, which means that the expected return on one bond does not influence the expected return on a bond of a different maturity, but it allows investors to prefer one bond maturity over another. So, in the other words, bonds of different maturity are assumed to be substitute but not perfect substitute. So, for this theory, the investor tend to prefer shorter term bond because this bond bear less interest rate. For this reason, they must be offered a positive liquidity premium to induce them to hold longer term bonds.
Now, me and Sharia are going to explain the facts that are explained by the expectation theory and liquidity premium theory. The first fact is interest rate on bond of different maturity move together over times. Second fact is when short-term interest rates are low, yield curves are more likely to have an upward slope. And when short-term interest rates are high, yield curves are more likely to slope downwards. And the third fact is the yield curve almost always slope upwards. For the expectation theory, this theory explains the first and the second facts. To prove the fact, we are going to do some calculation. Let's say that the present bond market provides investor with a 2-year bond that pay on an interest rate of 20%, while a 1-year bond pay an interest rate of 80%. The expectation theory can be used to forecast the interest rate of a future 1-year bond. The first step of the calculation is to add 1 to the 2-year bond's interest rate. The result is 1.2. The next step is to square the result, so we're going to get 1.44. Divide the result by the current 1-year interest rate and add 1, so we're going to get 1.22. To calculate the forecast 1-year bond interest rate for the following year, subtract 1 from the result. So we're going to get 0.22, which gives us 22%. In this example, the investor is earning an equivalent return to the present interest rate of a 2-year bond. The second fact can be proven by this graph. A positive upward yield curve occurs when yield of shorter maturity are lower than yield of longer maturities, and vice versa for inverted downward sloping yield curve.
Next, I'm going to explain the liquidity premium theory. Basically, this theory is the modified version of the pure expectation theory. This theory explains all of the 3 facts as my previous group mate already present the 2 facts. I am going to explain the last fact. Since both bonds have the same yield, to lower the demand for longer term bonds, a liquidity premium, this premium is required. As you can see from the graph, the yield curve typically slopes upward by recognizing that the liquidity premium rises with a bond maturity because of investor preference for short-term bonds. Even if short-term interest rates are expected to stay the same on average in the future, long-term interest rate will always be above short-term interest rate. Thus, the yield curve will typically slope upward.
Next, I'm going to explain about yield curves. But first, please note that yield to maturity is the expected return of a bond. A yield curve is a line that plots yields, which is interest rates of bonds having equal credit quality but different maturity dates. The slope of the yield curve gives an idea of future interest rates, changes, and economic activity. Yield curve is a graph that represents the relationship between the remaining time to maturity and the yield to maturity of a bond at a given point in time. There are 3 types of yield curve. The first one is upward sloping yield curve, or we can call it normal yield curve. This happens when long-term interest rates is bigger than short-term interest rate, responding to economic expansion. In this situation, when investors expect longer maturity bond yields to become even higher in the future, many of them will temporarily park their funds in shorter term securities in hopes to purchase longer term bonds later for higher yields. We will go to the next one, which is downward sloping yield curve, or we can call it inverted yield curve. This curve happens when long-term interest rate is smaller than short-term interest rate, responding to economic recession. Back to the first situation, the increasing in demand for longer maturity bonds and the lack of demand for shorter-term securities led to higher prices but lower yields on longer maturity bonds, and lower price but higher yields on shorter-term securities, resulting to inverting a downslope yield curve. And the last one is flat. This curve happens when the economy is transitioning from expansion to slower development.
That's all from us.
Bye.
Bye-bye.